I'm Edward Golding, Executive Director of the MIT Golub Center for Finance and Policy here at Sloan. It is my distinct privilege today to introduce our speaker. Susan M. Collins is President and CEO of the Federal Reserve Bank of Boston, where she participates in the Federal Open Market Committee, which sets U.S. monetary policy. Since taking office in July 2022, Collins oversees all bank activities, including economic research and analysis, banking supervision and financial stability efforts, community economic development activities, and a wide range of payment technology and finance initiatives. President Collins is an international macroeconomist with a lifelong passion in policy and its impact on living standards. She has published widely and served as provost, dean, professor, research scholar, and board member of a wide variety of universities and organizations, including Michigan, Brookings, Georgetown, and Harvard. President Collins earned her PhD here at MIT in economics and also has an undergraduate degree at Harvard. Following her remarks, President Collins will be joined on stage by Professor Kristen Forbes for a fireside chat, followed by Q&A from the audience. So President Collins, the stage is yours. Thank you.
Thank you very much. And it's just such a pleasure to be here with all of you today. I want to give a sincere thanks to Kristen Forbes, who I have known for many decades with such great pleasure, and also to Ed Golding and the entire staff for hosting and inviting us here. Much appreciated. It's been something that I have been looking forward to, and appreciate the Golub Center for Finance and Policy as well. Kristen, I do have to say that your impact and inspirational work, both in the US and globally, has really been tremendous, and you're such a wonderful colleague to me and so many other people, so thank you for that. As a former educator, I just always love being with students, and it is a just special pleasure to be back here at MIT, where I did get my PhD a few years ago, but so many of those memories feel like they could be yesterday. My time in the economics department was a phenomenal preparation for what turned out to be a very varied career, and that certainly wasn't expected or anticipated. That preparation involved a ton of work, and I'm sure you can all speak to that, but also lots of learning and really genuine investment from a remarkable faculty and many, many wonderful, long-lasting relationships, and I hope that all of you can speak to each of those things as well. So today I'd like to share my perspectives on the US economy and on monetary policy as the Federal Reserve works to achieve its dual mandate from Congress and to support a vibrant economy. First of all, my usual disclaimer: my remarks are my own and don't necessarily reflect those of my colleagues at the Federal Reserve Board or on the FOMC, the Federal Open Market Committee. So I'll begin with a brief overview of the Fed and its varied roles in the economy and financial system, and then I'd like to discuss the economy's performance in the post-pandemic recovery and monetary policy's role in restoring price stability. I like to give my bottom line up front. I often think that's helpful just to provide a bit of structure to kind of hang points on. And so to preview my core policy perspective, I'm committed to bringing inflation sustainably back to our 2% target. I, for a long time, have called myself a realistic optimist. And what I mean is that while I'm realistic about the risks and the uncertainties, I do remain optimistic that this can be accomplished in a reasonable amount of time and with a labor market that remains healthy. But there's a significant amount of uncertainty around that outlook, and the recent data lead me to believe that it's just going to take longer than previously thought, and there is no preset path for policy. It requires us to be methodical, to make decisions based on a holistic review of the data, and to be patient. So Congress established, and I'm realizing I have slides and had not started them up there, so let me do that. So initial title and just to get things going. So Congress established the Fed as the U.S. central bank more than 110 years ago, and our responsibilities all involve fostering a strong, stable economy and financial system in the public interest. Of course, economies have many dimensions, and so, in fact, the Fed's portfolio of work has a very broad range. I like to say that the Boston Fed's mission is supporting a vibrant and inclusive economy that works for everyone, not just for some people. There are 12 Reserve Bank districts, and the Boston Fed's district is most of New England. And we actively engage with stakeholders across all 6 New England states to learn about economic experiences, challenges, opportunities, but also to provide some transparency about what the Fed does and why, because really most people have very little idea what the Fed actually does. We're, of course, best known for conducting monetary policy, and that's what I'm going to speak more about, and all of the analysis and research that underpins it. But we also supervise some of the nation's financial institutions, provide back-end infrastructure and services for payments and financial systems. We examine factors that could limit people from participating in the economy, and a lot of that's motivated by our full employment mandate. And we support research and collaboration to expand prospects for community economic development. And since I'm at MIT, I have to mention that the Federal Reserve, and particularly the Boston Fed, has helped encourage innovation in financial technologies and payment systems, which we, of course, all rely on. And many of them are like the plumbing that, when it works well, you're not thinking about it, but in fact is really important for so much that we do. We played key roles in the emergence of automated clearing, check imaging, digitized procurement and payments tools for US Treasury. More recently, we worked actually in partnership with MIT researchers to explore the potential for a central bank digital currency, deepening our understanding and preparation in case Congress were to request a digital currency. And we recently built and launched FedNow, which is an instant payments rail that enables all financial institutions to provide their customers with real-time payments. So let me turn now to the economy and my outlook and monetary policy, and I am going to reference a few charts along the way. So just to start to kind of set the stage, this figure 1 focuses on the Fed's dual mandate from Congress, price stability and maximum employment, and provides a bit of historical context. So the left panel shows inflation using the Fed's preferred PCE measure. The blue line, of course, is total 12-month inflation, and the red line is core inflation, which excludes the volatile but obviously hugely important categories of food and energy. And then the green line is the FOMC's 2% inflation target. On the right, you see the unemployment rate, which typically shows a gradual recovery after rising during recessions, but the post-pandemic recovery has been highly unusual, and that's actually a theme that you'll hear through my remarks, because after spiking, unemployment fell very quickly, and it's now been below 4% since December 2021. The chart also shows that while significantly down from its peak, inflation remains above target. And high inflation is really like a tax that affects all of us. And in my travels around New England, people frequently share examples of its challenges. And in particular, the toll is especially large for lower income households that struggle to make ends meet. High inflation also impacts firms, complicating their budget and planning decisions. And so a high inflation environment, which highlights is really not consistent with maximum employment that's sustainable, and that highlights the complementary nature of our dual mandate, and also the reasons for my very resolute commitment to bringing inflation back to 2%. So FOMC has obviously been very focused on bringing inflation back down by raising the federal funds rate to slow demand and help realign it with supply in both product and labor markets. And after beginning to tighten in 2022, rate hikes were unusually rapid, moving the monetary policy stance from highly accommodative to restrictive. And that's also something that's an aspect of being unusual. So since July 2023, the federal funds rate has been at its current level of 5.25% to 5.5%, and we're now patiently assessing how long it will be appropriate to maintain this target range, and then that's kind of a key setup. So before I say more specifically about my outlook and the implications for monetary policy, I want to discuss some dimensions of this very unusual cycle. And a theme of uncertainty, both in the data and key economic relationships, remaining elevated is kind of reinforcing that need for patience. So as I've already mentioned, the rebound in economic activity after the pandemic shock was surprisingly strong and rapid relative to past recoveries. And what this figure does is for real output on the left and payroll employment on the right, compares the pandemic recovery, which is shown in the blue line, with the average of the past 3 recessions, which is shown in the red line. And the figure really highlights the degree of disruption in economic output and employment from pandemic-related shutdowns and the comparatively quick recovery. And a lot of that rapid rebound can be attributed to unique dimensions of the pandemic-driven downturn, including, of course, the highly accommodative monetary policy and the unprecedented degree of fiscal support. But that fast, and there's lots more that one could say about that, but I think it helps to highlight just how different this cycle is from previous cycles. And that's a theme that comes out as well in terms of asking, what should we expect and how should we think about that. But that fast bounce back came at a cost. Inflation surged, sparked by demand outstripping supply, and pandemic-related global production challenges, limited labor availability, transportation bottlenecks, Russia's war in Ukraine, all of those things worked to constrain supply, and as that situation was compounded by a shift in consumption patterns away from services towards goods. And so that's an example of some of the uncertainties related to relationships, as well as uncertainties related to data, which have been quite unusual during this pandemic cycle. In this context, an essential part of restoring price stability really entails realignment through a combination of supply improvements and demand moderation, because that dynamic of demand outstripping supply puts pressures on prices and on wages, and has been a key dynamic that is relevant and speaks to the role that the Fed can play. Well, the surge in inflation was widespread, and that is illustrated, for example, in this figure, which splits core PCE inflation into its 3 main components. And I find the decomposition here really informative, and I look at it not because we have specific additional targets for particular components. Our target is total PCE inflation measured over a 12-month period, but because these components behave very differently. They have different dynamics, different determinants, as we think about how things are going and what our outlook looks like, decomposing that, I think, really matters. So the blue lines show inflation over a 12-month horizon, which is comparable to Figure 1, and the red lines show a 3-month horizon that reflects more recent data, but also show more volatility or noise. And so looking again at different indicators is quite helpful in terms of constructing a broad picture. And the charts show that the run-up in core goods inflation on the left panel was particularly fast, due in part to the household pandemic-related shift from spending on services to goods, and some of the supply constraints I talked about. In the middle and on the right, housing inflation and core services inflation, excluding housing, also rose notably, but with a bit of a lag. And the rise in housing inflation was driven by a surge in rents, in part due to housing supply shortage issues, and there's a lot more one could say there. And rapidly rising labor costs contributed to the rise in inflation for other core services. And of course, that is a large sector, over half of core PCE, and it's one in which wages tend to comprise a large share of firms' expenses. So while total PCE inflation peaked in February 2022, the sustained easing of price pressures really began later that year and was particularly noticeable in 2023, when core PCE inflation fell roughly 2 percentage points. And that was the result of supply and demand moving into better alignment. And importantly, much of the economy's surprising performance last year, especially in the second half of last year, can be attributed to positive supply developments, some of which were expected, but some of which really were not, including supply chain, labor supply, labor productivity, and I will come back to that. So in particular, supply improvements enabled significant disinflation in core goods. Similarly, housing inflation moved down with recent rents for new leases returning to pre-pandemic levels, and the additional supply of rental units coming online. And inflation in other core services moderated as supply challenges and cost pressures improved. And I do want to just briefly note two other developments in 2023 that really highlighted the significant progress that was made towards achieving our goals. The first relates to inflation expectations. Being in line or with readings that are historically associated with inflation being around its 2% target. Because expectations are such a key determinant of current behavior, they influence actual inflation and its evolution, and they're very high on my watch list. Figure 4 shows a variety of indicators of expectations. The right panel shows that longer-term expectations remained actually well anchored throughout the downturn and recovery, which is consistent with the Fed's credibility in terms of its commitment to restoring price stability. But short-term inflation on the left side, expectations, did jump in 2021 and then decreased to levels consistent with the 2% target by the end of 2023. So that was some additional kind of strong news about progress being made. A second thing I'll just briefly mention is that price changes across narrowly defined industries were also much less correlated in late 2023 than they had been in 2021 and 2022. You can think of this as the synchronicity of price changes, and reduced synchronicity is actually consistent with large price gains being less common across sectors, and is consistent with a kind of low inflation regime as opposed to the direction that we had been heading, which has more synchronicity, which is consistent with a higher inflation regime. So that was also good news. So while some of the decline in inflation had been widely anticipated, output growth was much stronger than expected in 2023, increasing 3.1% over the previous year. And given that robust growth, the realized decline in inflation was really quite remarkable and, of course, very welcome. Well, it's now May 2024, and while economic activity has remained relatively robust and the labor market healthy, at the same time with signs of coming into better balance, we have not, unfortunately, in 2024, seen further disinflationary progress. Going back to Figure 3, that showed that over shorter horizons, inflation has picked up in both core goods and core services, excluding housing, and it's actually moving sideways for housing. So, on the one hand, the actual data is very noisy. If you look at monthly inflation numbers, the volatility is still elevated compared to historic numbers. And I would say that unevenness in the disinflation process is to be expected, is not a big surprise to see some less welcome news after such a string of positive inflation developments, but it's enough data that it's important to really take seriously. And going forward, we cannot necessarily count on continued supply-side progress of the pace we saw before to reduce inflation amid strong economic activity. In particular, the goods sector is unlikely to contribute much more to disinflation, though it's possible that some of the previous improvements haven't been yet fully reflected. And while new tenant rent growth has generally returned to pre-pandemic levels, rents of existing tenants are still catching up and continuing to put pressure on housing inflation. And it's likely to take some time before we see that pass through. And then additional labor supply and productivity gains are highly uncertain. So progress on inflation will very likely require lower growth in demand, particularly to facilitate further slowing in the core non-services inflation piece. So against this backdrop, a key question is really how to think about realigning supply and demand going forward. And there are a lot of dimensions to consider there, but what I'd like to do is focus on the relationship between wages and prices, which is especially important for core services excluding housing. And in particular, what I'd like to do is explore a common concern that rapid wage growth may be fueling price pressures and preventing disinflation. So Figure 5 shows the recent evolution of both wage growth, which is the blue line measured by ECI, the Economic Cost Index, and PCE, price inflation, which is the red line. And it shows that recent wage growth is above its pre-pandemic range, and also that the current gap between wage growth and price growth is relatively large. But the chart also shows that inflation grew much faster than wages earlier in the recovery, so wages are in part catching up to past price increases. Moreover, real wages or wages adjusted for inflation should track growth in worker productivity over the medium to longer run, but the real wage growth observed over the course of this recovery has yet to match measured productivity gains. And Figure 6 illustrates this point by showing the gap between real wages and productivity. Real wages, which is the blue line here, fell during the pandemic and initial recovery before retracing most of the decline. By contrast, labor productivity increased notably at the start of the pandemic as production initially shifted from less productive services to more productive goods, and then decreased some during the unusual economic reopening and recovery, but it's picked up again more recently. The main takeaway here, and again, there are a number of different ways to measure wages and productivity, but that gap is something that comes through. And the main takeaway here from the evolution of wages, prices, and productivity is that in real terms, labor remains less expensive than it was before the pandemic. And importantly, this conclusion also holds when we consider wage and price indicators measured from the perspective of employers. Labor now accounts for a lower share of businesses' costs overall, which is reflected as well in a declining portion of output going to compensate workers. And so labor's share is now roughly 2 percentage points below its 2019 average for the total economy, and that pattern holds for most industries. So overall, firms appear well positioned to potentially absorb some faster wage growth without placing additional pressure on prices. And I say potentially because with robust demand, there's still a possibility of passing higher wages through fully to prices, and those dynamics may have been at play in the first quarter of this year. But that said, continued productivity gains could allow further solid but non-inflationary wage growth. Interestingly, other highly industrialized countries have not seen similar favorable labor productivity developments as shown in Figure 7. Now, reasons for this difference are unclear. It's obviously productivity is something that's very complicated, measured with error, and this obviously warrants quite a bit of study. And I will also note that productivity gaps were also evident before the pandemic. But one possible explanation is that differences in the labor market reallocation process across countries following the pandemic shock may have resulted in better matches between employers and employees in the United States. Whatever the reason, it seems likely that recent U.S. productivity gains largely represent a level adjustment rather than a persistent increase in productivity growth. Still, my employer contacts around New England continue to mention ongoing technological investments and process optimization efforts, and that suggests that there could be more to come in this level improvement in productivity. But still, future path of productivity is obviously highly uncertain, and a slowdown in activity, I believe, will be needed to ensure that demand is better aligned with supply for inflation to return durably to the Fed's 2% target. So in this context, the role of monetary policy is to restrain demand to help facilitate an orderly realignment process. And the recent upward surprises to activity and inflation suggest the likely need to keep policy at its current level until we have greater confidence that inflation is moving sustainably towards 2%. As emphasized in last week's FOMC statement, the committee's decisions will remain data dependent, carefully assessing the constellation of available information. But policy not only needs to reflect a steadfast commitment to restoring price stability, but also to aim to preserve a healthy labor market, which is, of course, the other facet of our dual mandate. There are risks from easing too soon, which would make our job of restoring price stability more difficult. And there are risks from holding rates high for too long, which would lead to unnecessary economic disruptions. A moderately restrictive stance, which is how I view the current policy, may be the appropriate approach for balancing risks that are two-sided. I do expect that demand will eventually slow as needed to better align with supply, but the timing and magnitude of moderation remain uncertain, and it's also possible that policy became restrictive more recently than thought and that we've yet to see its full impact, especially if the economy becomes more interest sensitive over time as firms refinance their existing low-cost debt and households exhaust the excess savings accumulated earlier in the pandemic. The current situation requires that methodical perseverance, recognizing progress will take time and will continue to be uneven. Expecting all of the indicators in this uncertain, complex context, that's too high a bar for us to start normalizing policy. And so among the many things that I watch carefully, here are 4 things that I highlight that I'll be watching for. Short and longer term inflation expectations remaining well anchored. Further sustained disinflation, especially in the components that remain elevated. Evidence that wages continue to evolve in a way that's consistent with price stability. And ongoing indications that labor markets are moderating in an orderly way that better aligns labor supply and labor demand. But overall, policy remains well positioned to respond to incoming information as we assess the evolving outlook and the risks. And the unusual nature of this cycle, the continued high degree of uncertainty and the still elevated inflation, all highlight the importance of patience, analysis, and I would say a bit of humility. So I'll end by saying again what a pleasure it is to be back here at MIT. As I bring up my final slide, I just want to say to the students who were here, I took a look back at the Sloan School's mission statement, which includes the phrase to develop principled, innovative leaders who improve the world. And I just want to encourage each of you to take each aspect of that to heart, knowing that you have a lot to offer our world. Extraordinary things happen when we care, when we study issues, when we collaborate with purpose, and when we act. And this slide shows some of the ways and some of the people that I'm meeting with who are doing just that. So best wishes to all of you. Thank you. And now I look forward to the conversation and to your questions.
Let me just start again and say thank you again for coming in to see us, especially on this gloomy day. I hope you have some time to walk around the area at some point, again, maybe not today, and just see how much things have changed since you were here. Not only since you were here, I feel like even I go away for the summer and come back, things have changed. And it's a great example of the vibrant economy in this region, in this area. So particularly grateful for you being willing to take some questions, first for me, and then we're going to open it up to the broader group. So the game plan is I'll ask you a couple questions about just the broader outlook, building on your comments. Monetary policy in specific, have to take advantage of having you here and having just had a meeting, and then the international economy, and then we'll open it up to questions from the floor.
Perfect.
Okay, so first I want to build on a theme that just came through again and again in your comments of just the strength in the US economy. How surprising it has been that given you've raised interest rates 525 basis points in a fairly short amount of time, the economy's held up quite well. There hasn't been the recession many people were predicting last year, not even really much slowdown in growth. Unemployment sort of bouncing around a bit below 4%, so just very solid economy, growth, unemployment. I was wondering if you could talk a bit about why there hasn't been more effect of the sharp increase in interest rates. Is it that we just need more time? There's lags from when you raise interest rates until it affects the economy. Are those lags slower this time around for some reason? Or has something changed so increases in interest rates may not be as potent as they have been in the past?
So lots of things to say there. Let me unpack a few of them. But perhaps the framing is that, this is still evolving. And so, down the road when we look back, I think we will have more information to try to parse out some of the different things. I think there are a lot of dimensions of the current context that have helped to make the economy so resilient. And it's hard to parse out what the effects are. One of them I would say is that compared to previous downturns, households and firms had very strong balance sheet positions, and perhaps even stronger than was recognized given the refinancings that had happened in a variety of other contexts. And so the support, the fiscal support, the strength financially of households and firms, I think is a huge part of why that rebound has been so resilient. But again, it was more so than many anticipated. I'd also say some of the supply improvements that I talked about, this very strong labor market has helped to bolster households' ability to spend. I will also say there's some behavioral things that we're still understanding. Savings rates are super low. And so the willingness to continue consuming at the high level, there's some puzzles there as well. So I think that there are multiple things that are going on. I also, and some of those do make the economy less interest sensitive. I expect some of that to wane. And so I do think that, and I see the effects of the restrictive policy, which I would consider moderately restrictive, in terms of some of the rebalancing that we're seeing in some of the most interest sensitive sectors. So I do think that holding in this restrictive range for longer will, in an orderly way, in my baseline, would slow the economy to realign. In terms of lags, I think that's super interesting, right? I mean, if you went back to previous estimates, it might have said that 4 to 6 quarters after becoming really restrictive is when you'd expect to see the peak effects. We've been at the 5 1/4, 5 1/2 for 3 quarters, and it came after a period of very low interest rates, which is still wending its way through those long and variable lags. And so what the net effects of all of these things are, even from the past models, I think is harder to really parse out. So I think it's too soon to tell whether we've really seen a change in the lags and just how restrictive we're being and how much of it is these special factors.
So let me build on that. As you went through the strength in the economy, one piece that stands out is inflation. Obviously, it's come down nicely overall, but now progress has stalled. Yeah. Inflation has been stickier. You didn't use the S word. It seems to be a popular word in other circles, but inflation's been a little stickier coming down than expected. Some of that is undoubtedly the strength of the economy for the reasons you just cited. Yeah. But there's also a school of thought that the price setting process may have changed and wage setting may have changed. Your graphs suggest wages haven't fully caught up to real wages haven't caught up to inflation, but overall still there could be a story where the period of very high inflation has changed how companies set prices and possibly wages. Do you think that has occurred? Do you see any evidence that's occurred? And then just to sort of related, if it has occurred, if the price setting process has changed, is the economy more sensitive to shocks now? So if we get some other sort of oil price shock, hypothetically, are you worried we could see inflation pick up more quickly than we would in the past?
Yeah, so when inflation surged, we certainly saw changes in the price setting process, right? Just to give one example, firms that had reset their prices typically once a year were doing it 3 or 4 times a year. And there's lots of evidence of that, quantitative, qualitative evidence. And that starts to move into characteristics of what I'd think of as like a high inflation regime in which the processes are different. When I talk to people, to employers, what I'm hearing is a move back towards what you might call a more normal or what was more historically common in terms of how frequently prices are set and how the people are thinking about wage setting. But I don't think that we know as much about that transition back, how long it takes, how you tell whether you get all the way back or partly way back. But what I'm hearing anyway is consistent with that not having been entrenched in what was starting to be some different processes. But one other thing I'll just say quickly is that if you look at wages, a lot of the real surge in wages was new job entrants and job changers. Turnover was really high. And so what started happening was that you had, in order to bring people in when there was such labor shortages, you had to pay a lot more. But that caused a lot of compression of the wages of the existing people who are most of it, right? There's a bit of a marginal and then average thing going on there. The wages of new entrants and job changers with job turnover way down. It's back essentially to the ranges pre-pandemic. The wage growth there is also in the ranges that we had seen pre-pandemic. And so a lot of the evolution on wages is really firms figuring out how to adjust to that compression. And I don't think that we really know exactly what that dynamic is going to look like, how long it's going to take. What I hear around the district is many firms having really moderated what they're expecting and what their employees are expecting in terms of wage changes. So I think that it's evolving, but.
Okay. Let me put you, when you talk about the strength of the U.S. economy, there's two sets of theories I've heard gaining more prominence. I wonder if you put any weight on them. One is that with interest rates high, this is foreseeing more creative destruction. That because it costs more to borrow, harder for less productive firms to stay in business, we're just seeing more turnover, inefficient firms are closing down. And this is driving some of the productivity growth you documented nicely there. This is sort of the opposite of what an area the Boston Fed actually did some nice work on in the 2010s, where there were a couple conferences on how low interest rates may be contributing to low productivity growth because inefficient companies could stay in business. Then there's another school of thought that the economy has held up quite well because we focus a lot on how higher interest rates raise debt costs. People are paying more on mortgages and credit card debt. But we forget the other side of the asset sheet, that people who actually have money in savings accounts or hold fixed income investments are actually earning some money now versus in the past when you earned about zero, when rates were about zero. Do you think either of those channels could be more powerful and part of the explanation why we're seeing stronger growth, whether it's why household incomes are holding up better than expected? They're earning more in savings, but especially if you have a fixed rate mortgage, not paying more on your debt, or stronger productivity growth from higher interest rates.
Yeah, so I think that there are dimensions there that are playing a role. Yeah. From what I see, I think it's not clear to me that they are playing a bigger role than they might have before. And let me just say a bit about each one. So on the firm side, this idea with low interest rates that you had these zombies firms that weren't being pushed in order to move productivity. So, I do think that in a high interest rate environment, it does, create incentives and kind of push productivity. But there are other dynamics there, and in particular, in an environment in which you couldn't find workers and input costs were just skyrocketing, that created, before interest rates went up, this, I think, a significant push for many firms to figure out efficiencies and on cost saving. And so that dynamic, to me, is likely to have certainly started before and maybe stronger than the other one. And it's hard to, I think, tease them apart. And then on the household side, there's always winners and losers when interest rates go up. And I think we often focus just on one side of it. And I think it's helpful to remember that it's absolutely true that with higher interest rates, that benefits some people and enables. But again, I think that interacts with some of the other special features of this environment. And but I don't know that I think of that as a new dynamic. I think some of that was always there.
Well, I look forward to the Boston Fed updating its nice research it did in the 2010s on how low rates might affect productivity growth.
Just
we'll need some time.
One other just quick thing there. I mean, one of the things that happened with a number of the fiscal supports was this big increase in entrepreneurship. We have had this real increase in the number of new firms, and it's too soon to tell if that will help create a productivity boost. But that was less interest rate related, right, and more related to other factors. Yeah.
So let me drill now into the monetary meeting you just had, the FOMC meeting. I'd like to, so what comes next is the question obviously on everyone's minds. The Fed's had to adjust as inflation has been a little stickier coming down. And now it calls for patience, as you repeated in your comments. And you went through this nice constellation of indicators that you'll be watching. I like the term constellation, bringing the stars theme back in, which Chair Powell has used in the past. But in your constellation of indicators, you'll be watching to know when it's time to ease monetary policy. It's a pretty broad list. And obviously, there's no one data point that's going to make you change your vote. But could you narrow it down? Are there sort of 2 or 3 or 4 indicators that you put a lot of weight on that really change your thinking, whether they move in the right direction or not? To give you a minute to think, I'll tell you, when I was at the Bank of England, one of my favorite indicators was quits rate. I found the quits rate it had very high correlation with what happened with wage growth.
Yeah.
It also seemed to, because as people switched jobs, that's when you saw big job gains. But it also seemed to capture the confidence of workers in the state of the economy. You're willing to quit a job without having another one lined up necessarily because you are confident in the overall economy. And that seemed to capture something and work pretty well. So that was one I put weight on. I bought you a minute to think. Are there a couple that you put most weight on?
So I'm actually going to resist that a bit, in part because the way that, I think more that there's almost this big jigsaw puzzle. And what we're seeing are different pieces that are part of the puzzle, and we're trying to use that to pull out what a picture is. And so I tend to try to absorb both a number of statistical data, what the model analyses are saying, but also what I'm hearing in qualitative conversations, which sometimes has me go back to the data to say, are you seeing this? How are we thinking about that? And I would also say that I think things have evolved. So, earlier in the pandemic, we're so focused on supply constraint measures, which would not have been at the FOMC table earlier. Now that's just standard. We've just woven it in. So so that list of 4 was me pulling it down, actually. And I think that there are certain sectors that I'm more focused on those sectors where it is stickier. I had used the word a bit recalcitrant, in kind of earlier settings. But I would also note that a year ago, there was very little movement. Then there was significant movement, and now we're back to a period in which there's not so much movement. There may be other dynamics going as well that require us to be patient. So I know that's a bit frustrating, but yeah, I don't really have
but wise. I think back to when central banks have in the past focused on one indicator, then often there's something unusual or it bounces around, and then you can be trapped in people expecting you to respond to one indicator when the rest of the data doesn't go your way. So wise decision not to focus on any specifically. One more question on the FOMC meeting. So there were 2 main takeaways from the meeting. For those of you who didn't read the statement, that basically one of the main takeaways was no change in interest rates. So there will be some delay in lowering interest rates relative to what expectations were earlier in the year as you wait to see inflation sort of coming down as hoped for. And that's broadly a tightening of financial conditions relative to what was expected at least a couple months ago. The second key message from the meeting was that you would slow the pace of QT. So slow the pace that you are reducing the balance sheet in your asset holdings. So that is a tightening of a loosening of financial conditions. So part of your sort of statement was an easing of conditions and part was a tightening of conditions. How do you square that when what you're doing with balance sheet policy sort of at a high level looks like it's moving in the opposite direction of what you're doing with interest rates?
Yeah, so I really think of the 2 in this context as quite different. So just very briefly, our primary tool to achieve our dual mandate is really focusing on interest rates. And the approach related to QT is to move back to what will then become a more normal environment. That's happening passively in the background. And so unlike with QE, where you do that in a crisis and it's hard to really send a signal, and so there are no surprises and everything is moving slowly, the real goal here was through the discussion that was reflected in the minutes in the March meeting, and then the decision that was part of this meeting. I believe the markets likely have already priced in what we're doing. And so having that happen in the background to make it more likely that the reduction in the runoff in the balance sheet will be orderly, will not create stresses, and will help us to be well positioned and have the time to decide down the road. Absolutely no decisions have been made at this on this yet, of how far to go. And so making sure that that happens in a quiet, orderly way in the background, and I'm not thinking about that as active monetary policy at all. So I really see them separately, and I don't see them as being in conflict.
So we all know your mandate is the U.S. economy, but I can't resist but ask you some questions about the broader international economy, especially as much of your academic work was on international economics earlier in your career. So let's 2 questions on the international economy. First, one of the slides that was really striking in your presentation was the outperformance of U.S. productivity growth relative to other countries. That's undoubtedly part of the reason U.S. growth has held up more. But do you have any, so U.S. growth has held up more because of the stronger productivity growth you document, but also part of this story is undoubtedly labor supply. U.S. labor supply has held up quite well. The April statistics showed the labor force participation of females in the U.S., working age females, is now at its highest level on record, which record started in the 1940s. So it's really remarkable performance in terms of labor supply and productivity growth. You offered one potential explanation for stronger productivity growth in the US was just the labor market policies during COVID. But do you have any other evidence or thoughts on why the US growth has held up so well, particularly labor supply, as well as productivity growth?
Yeah, so there's a huge set of really important, interesting questions there, and I'll start by saying that it's something I'm really interested in. So I will be, I'll offer some thoughts in that space. And I have so many memories of earlier conferences where we talked a lot about many of these international topics. So I do think that the labor supply dimensions are quite interesting. The increase in labor force participation, not just for women, but for prime age women, was not expected. And especially in the broader context of challenges with childcare and dependent care more generally, which we've not addressed. I see them very much as economic issues. It's actually something the Boston Fed team is actively engaged in. I think there's some really big surprises there. The extent to which we're managing as an economy the flexibility of work might actually be helping to offset the availability of job opportunities for more people. There actually are increases in labor force participation for those with disabilities. So there are a variety of other groups that we don't always look at as much that have also more come into the labor force that are part of the story. I can't speak to how much that might be happening in other countries, but I do think that understanding more broadly dynamics in our labor markets and the extent to which different ways we're thinking about how to use technology and how to do work could be playing a role is one direction to consider. I said a little bit about some of the productivity. I think that's ongoing and, again, hard to measure. But I do think there's a lot to dig in there, and I do think the differences are interesting and striking, and so appreciate you bringing them up.
Yeah. So these differences are leading to what is top of mind at international meetings, which is divergence in the global economy. The U.S. economy is holding up well, as you've described. The Fed will be slower to lower interest rates than in other economies where growth is not as strong and inflation is coming down faster. So how important, so this divergence in economic performance and monetary policy is going to have spillover effects on capital flows, trade, exchange rates, et cetera. How much do those factors weigh in on as you evaluate the U.S. economy in monetary policy decisions? For example, I can expand a little more. This fact the U.S. will keep rates so where they are for longer means the dollar's stronger. This explains part of the strong dollar right now. As other economies start to lower interest rates, that will lead to capital outflows from other economies into the U.S., so there'll be some shifts in capital flows. Strong dollar combined with strength in the U.S. economy will contribute to a larger U.S. trade deficit. You could go on and on, but there are a lot of effects like that. How important are those international effects resulting from divergence as you think about monetary policy?
So the first thing that I say about that is that as part of my own preparations, but also more generally the combined preparations that we do, we look at the international dimensions and the international focus, a huge part of the different models that we explore and that we look at. And so many of those pieces are actually factored into how we develop an outlook for what is, so what are the exchange rate channels? What are some of the channels through import prices and international trade? So a lot of that is very much factored in. And there's certainly, and that would include commodity prices and issues related to energy. And so all of those things are very much engaged. Given our mandate, we do focus on implications for our PCE inflation and maximum employment in the US, but they're very much factored in there, and depending on what's actually happening in a particular time period, we'll have more or less discussion about a particular dimension of that. I have to say, from my perspective, one of the very interesting sets of dynamics. The other thing I just have to mention as well, which is a little bit less macro, but we really learned a lot about the global supply chain interactions, and that is very much top of mind still in a variety of different ways, trying to understand the extent to which that's evolving, recognizing how important that is as we think about how big an impact shocks have on the US economy, the global economy, but also how long lasting they are. So an understanding of those global linkages, I think, is something that we've really learned and focused more on than would have been true perhaps in the past.
It's good they have you there to remind them about the rest of the world, yes. So I have one more question, and then we'll open it up to the floor. And Alejandra, you're on deck for once we get going. Andres will start passing around the microphone. But one just last question. You talked a bit in your comments about some of the work you do other than monetary policy. You know, it's easy. We all focus on monetary policy and the U.S. economic outlook. But how do you divide your time? How much is on FOMC meetings versus monetary policy versus other issues?
Yeah, so I would say that I'm always spending some time thinking about monetary policy. So that's always part of the portfolio, and during the times leading up to FOMC meetings, a lot. But the breadth of the portfolio is really important and really interesting. And so I would say each week is a bit different, which to me makes it very interesting, right? I mean, there are some weeks where I'm doing quite a bit of traveling, whether I'm visiting, was recently in Connecticut visiting with community leaders, employers of different sizes, trying to really understand what's happening there. So some weeks I spend quite a bit of time on some of that kind of engagement with our community development team. The work on FedNow, the payments infrastructure, has been something we're quite proud of and excited about. And it's early stages, but is something that in some periods I've spent quite a lot of time thinking through and working on as well. So I would say it evolves, but the overall portfolio, and then also working with our research team on the range of things they do, which include everything from, sometimes working on childcare, work on how climate change could impact local fiscal challenges. I mean, the breadth of work that we do to understand what a vibrant economy looks like is pretty broad, and so I spend time on all of it.
So that is a great lead on to some of the questions from the class. So a number of you sent in some questions via email. I'm now going to turn to those, and I'll structure the order and sort of the reverse order of the questions I asked you. So start off with some of the broader roles of the Fed, and then narrow it down into monetary policy again. You can't get away from that. But we'll start with Alejandro, and then Ria. Ria will be next.
Hi, President Collins. Thanks for coming today. My name is Alejandra. I'm a second year at MIT. And my question for you today is, how is the Fed adapting to technological advancements in financial services? And what role do you think digital currencies will be playing in the future of banking?
Yeah, so technology, first of all, the changes in technology have been tremendous, and that's still evolving. And they absolutely have a range of implications for financial services, and that's something that we certainly pay considerable attention to, both opportunities and benefits, but also costs and risks associated with them. So I mentioned in my remarks some of the work, the Hamilton Project with MIT, related to putting together, if we were to move forward with a digital currency, what would the technological platform look like? What would we need to know? And there's open source code on that project. And I also mentioned the FedNow project, that technological infrastructure for instant payments. So there's a range of different things that we work on, often in collaboration with others. Specifically in terms of digital currency, though, again, that would be a congressional decision.
And then Marcelo will be next.
It's still on.
You can't get away from a question on AI. We're at MIT.
Thank you very much. My question is around AI and monetary policy. What do you see as potential benefits and challenges of using AI in monetary policy and decision making?
Yeah, so I think it's a question that many people actually think about. So where are the uses of AI? And there's certainly a lot of work underway at the Fed and in other places. we wouldn't use AI for something as nuanced as monetary policy itself, but there are a variety of places, I think, where AI can help us to gather really valuable information about the state of the economy and about how it's evolving. Just to give one example, economists at the moment are using AI to try to understand. You can think of, text analysis. Expectations related to inflation, related to sentiment from firms, from a variety of large textual analyses. And I think some of that real-time data is an example of some of the kinds of things that can be very helpful for us going forward. And you can think of other examples in that space. But, of course, early days. And we also want to be very thoughtful and understand, working with others, what the implications will be for the labor force in the economy more generally, productivity, what kinds of reallocations there might be, and how that impacts a vibrant economy. So there's lots of pieces to that and lots of ongoing analysis and work. Thank you.
Marcelo's next, and then Josefina's on deck. I'm waiting for the paper that someone writes where they use AI to set monetary policy. And see what it would
they may have to be patient on that one. Well, right, I don't know about that one. For information, I think there's some of that work already underway.
Right.
Thank you so much. So you mentioned climate change, and any scenario where the U.S. actually decarbonizes is going to require several $1 trillion in investment. So I'm curious if you think of any role that central banks should play in that, and how you think about that.
So, what I would say is that different central banks have different mandates. The Fed's mandate in the climate change space is on the narrower side, right? And so we certainly are focused on financial implications for banks related to climate change implications of financial risk. There is a pilot underway to really try to dig into that more deeply, to try to understand what some of those implications would be. And there are a variety of other kinds of analyses along that standpoint as well. And I gave one example of some of the kind of research that some of our teams do. But the Federal Reserve has a kind of narrower focus in terms of the climate specific work that we do.
Josefina.
Hi, thank you so much for being here. So my question is how the Fed interacts with other central banks outside from the US, particularly in emerging markets, if they provide assistance or expertise, how does it work? Thanks.
Yeah, so there are actually lots of interactions with central banks around the world in a lot of different forums and at different levels. So certainly there are technical assistance programs, and many of those are longstanding. There is lots of interaction at the research side through conferences, through seminars, through networks. There's a lot of that analysis was shared work. In terms of policymakers, there are a number of kind of venues where people come together to talk through perspectives, to have understandings of a variety of different things. At the moment, we're certainly not coordinating monetary policy, but there's lots of interaction, again, at different levels through a variety of contexts, things like the Bank for International, BIS for International Settlements, but many other kinds of organizations as well.
Andres, will give you the last question from the floor.
Thank you, President Collins. My question is about, as we all know, the Fed is a technical institution, but it's been on the spotlight the last few years because of, monetary policy is a common topic now. And I was wondering, in a polarized political environment, how is the Fed addressing the new challenges and pressures, even when they're questioning the Fed independence in the future?
Yeah, so there is more than enough to keep me and colleagues busy focusing on monetary policy, understanding the dynamics of our economy. What I would say is that we have public affairs teams which support, and I'm speaking for Boston, but obviously there are similar teams across the different banks. In terms of how we do public engagement, I would say one of the very important things that we do is engage in a variety of different contexts. So for example, when Kristen first reached out to me and asked would I come and speak to the class, I said absolutely, and would even prefer to do that if we do it in a more public setting, because I would like to be able to talk more broadly to help people hear what we do and why we do it. And I think that transparency, that sharing of information is really important and is part of public engagement. It's part of why I spend so much time on the road, because I don't think most people understand what we do. People aren't all going to agree, but I think it's helpful to be able to ask a question, hear an answer, and at least be told, here's how we're thinking about it and why. And also to hear, I'm very committed to our nonpartisan, rigorous approach. It's data-based and it is analytic, and providing a resource to others who are interested in the economy is important as well. So I think that kind of engagement and really, I'll say, sticking to our knitting. We focus on the work that we do and are happy to engage and talk about it, and we think that that's important. So thank you for the question.
So Andrew, one final question on a lighter note. A lot of this room is graduating, and only has a few more weeks left in the Boston area. You've been in Boston, for many years at different stages of your life. What are one or two things you'd recommend they all do before they leave town?
And it's so hard because I had so many kind of different incarnations. I was an undergraduate, more Harvard Square focused, a graduate student, more in this area. So all these different things. So hard to pick a couple. I will give you two things that are favorites. So first of all, as I think about my MIT days, I will always remember the first time I got taken to Toscanini's, which if you haven't been there for ice cream, and when I came back, I had to go to Toscanini's and just see what flavors were on their menu. One of my very favorite things to do also, though, which has evolved, is to just walk around this city, whether it's walking along the river, which has changed dramatically over the decades, whether it's walking across the bridge into the different communities. And it's one of my favorite things to do. I love to do it when, my roommates or friends from other places come. We go back and walk through places we used to go to and think about. So think about what's been meaningful for you and go and visit it. And then when you come back to Boston, if you do end up leaving here, go back to those places and reminisce. And I hope you enjoy doing that as much as I have over the years and continue to do. So thanks.
Thank you very much.
This was really a pleasure. Thank you.